Welcome back, everybody. Today, we're going to do a deep dive on MUFG, specifically their 2024 integrated report. It's really not your typical dry financial document. They're really pushing this whole challenge and agility theme,
Uh-huh.
and how they're committed to empowering a brighter future. I think for someone like you who's always looking for those smart investments, you'll find their approach quite interesting.
Yeah, what's fascinating is how they're weaving that commitment into their business segments. They've got this incredible range. We're talking top positions in commercial banking, trust banking, investments, securities, asset management, even consumer finance, like a financial supermarket. And they're strategically expanding each aisle.
That's a great analogy. So it's not just about being big, it's about being diversified and smart about where they're focusing their energy. But with roots going back to the 1600s, how are they staying agile in such a competitive landscape?
Well, that's the key question, right? They're not just relying on their legacy.
Yeah.
This report highlights a real push for innovation, especially in Asia. You see it with their MUFG economic sphere concept. Instead of just entering new markets, they're partnering with established banks, like Bank Danamon in Indonesia, Security Bank in the Philippines, and Krungsri in Thailand.
So it's less about taking over and more about collaboration. That seems like a lower risk approach to expansion. But how do they ensure these partnerships actually benefit MUFG in the long run? What's in it for them?
Well, they're aiming to create this massive interconnected financial platform. They call it AsiaX Digital, and it hinges on their Modi platform, the MUFG Openly Connected Digital Ecosystem. It's designed to reach underserved populations, promoting financial inclusion through technology.
Okay, so that's the social impact angle.
Correct.
But let's be honest, they're a business. How does this translate into profits?
Well, think about it. Millions of people across Asia gaining access to banking services for the first time. That's a huge untapped market. Modi allows them to tap into that potential customer base, generating new revenue streams and driving long-term growth.
Yeah, that makes sense. It's like they're building the infrastructure for the future of finance in Asia. But I'm curious, is there a risk they're spreading themselves too thin? How can they ensure they're maintaining strong performance across all these different segments?
They're emphasizing balance. The report breaks down their performance under the previous medium-term business plan, or MTBP as they call it. They actually smashed their return on equity, or ROE, target landing at 8.5%. That basically means they're making more money with the money they already have.
So for someone like you who's always looking for solid returns, that's a good sign.
Exactly. It shows they're managing their finances well and focusing on profitable growth. And for the next MTBP, they're aiming for a net operating profit of 2.1 trillion in 2026. That's a 30% increase from their 2023 results.
Wow, that's ambitious. But where's that growth going to come from specifically? They can't just snap their fingers and make it happen.
Well, they've identified 7 key growth strategies. For example, strengthening their domestic retail customer base, accelerating their corporate and wealth management business, and of course, capitalizing on Asia's growth through their AsiaX Digital strategy.
So it's a multi-pronged approach. Makes sense. But are they putting their money where their mouth is? What concrete steps are they taking to achieve these goals?
Well, one thing that stands out is their strategic investments. They poured over 700 billion into various initiatives during the last MTBP, from expanding their digital reach to acquiring companies like Albacore Capital in Australia, and more recently, Link Administration Holdings, a major player in the Australian pension management market.
That's interesting. It sounds like they're not just sitting on their cash. They're actively looking for opportunities to expand their reach and capabilities. But what about their partnership with Morgan Stanley? That's been going on for quite a while now, right?
16 years strong, and it accounts for nearly a third of MUFG's annual profit. They've really figured out how to leverage each other's strengths. MUFG brings the capital and the Asian market expertise, while Morgan Stanley brings global investment banking power and a strong U.S. presence.
So it's a win-win. But are there any potential downsides to such a close alliance? Does it limit their flexibility in any way?
Well, that's always a consideration with any partnership, but they've been pretty successful so far. It's interesting to see how they navigate that balance between collaboration and maintaining their individual strengths.
Okay, so we've talked about their diverse business segments and their ambitious growth plans. But how do they translate all this activity into tangible value for their shareholders?
Well, they're quite focused on that. For 2023, they increased dividends to 41 yen per share, a 64% jump from 2020. They're projecting 50 yen per share for 2024 while keeping a 40% payout ratio.
So they're sharing the wealth, so to speak. But dividends are only one part of the equation, right? What about other shareholder-friendly initiatives?
They've got a robust share buyback program They exceeded their target, repurchasing a trillion yen worth of shares in the last MTBP. Combined with dividends, that's over 2.2 trillion returned to shareholders.
That's a pretty clear signal that they're serious about creating value for their investors. But it also raises the question, are they prioritizing shareholder returns over long-term investments?
That's a fair point, and it's a balancing act for any company. They're also aiming to reduce strategic equity holdings to below 20% of their consolidated net assets. This will free up even more capital for potential growth and shareholder returns.
So they're trying to have their cake and eat it too. I'm curious to see how they manage that delicate balance moving forward.
It'll be interesting to track for sure, but it speaks to their commitment to both financial performance and creating value for their investors.
Okay, so we've covered a lot of ground here, from their sprawling business segments and strategic partnerships to their impressive financial performance and shareholder-friendly moves.
But it's more than just numbers. They're also emphasizing this agility transformation, a cultural shift within MUFG.
That's a pretty bold concept,
Yeah.
especially for a company with such a long history and established ways of doing things. Can a giant like MUFG really change its stripes?
They're certainly trying. They're incorporating agility into performance evaluations, reviewing procedures, and even flattening hierarchies to empower employees to make decisions more quickly and independently.
That's a pretty big change, but how do they actually measure the success of something like that? It's not as tangible as, say, their ROE.
It's more about fostering a mindset, a willingness to adapt and respond to change. It's about breaking down silos and empowering employees to take ownership and be more proactive. It's a long-term play, and only time will tell how effective it truly is.
But it sounds like they're taking concrete steps to make it happen. I'm intrigued to see how this agility transformation plays out, and if it gives them a competitive edge in the long run. But we've covered a lot in this first part of our deep dive, and I think it's time to take a breath and let you, our listener, digest all this information. What stood out to you so far? What aspects of MUFG's business or their strategy are you most curious about? We'll be back shortly to delve deeper into their financials and explore how they're quick to balance profit with purpose.
While we let our listener ponder, I keep thinking about MUFG's commitment to Asia, that MUFG economic sphere concept. It isn't just catchy, it's a bold bet on the region's future.
Yeah, it definitely caught my attention too. But Asia's a vast and diverse region with its own set of unique risks and challenges. What if those economies don't grow as projected? What happens to the sphere then?
Right, that's the million-dollar question. They're aware of the potential pitfalls. Geopolitical instability, regulatory hurdles, even natural disasters could throw a wrench in their plans.
So how do they mitigate those risks? Are they just crossing their fingers and hoping for the best?
They're definitely not passive about it. A big part of their strategy is forging those strong local partnerships. It's not just about injecting capital. It's about tapping into local expertise, understanding the nuances of each market, and navigating the regulatory landscape more effectively.
That makes sense. It's like they're spreading the risk while also gaining valuable insights. But they're also going beyond traditional banking, right? That Asia X digital strategy and the Modi platform seem like key pieces of the puzzle.
Absolutely. It's about reaching those who have traditionally been excluded from financial services. Think about a small business owner in rural Indonesia who can now access credit through a mobile app. That's the kind of impact they're aiming for.
So it's about empowering individuals and businesses, driving economic growth from the ground up. But how do they measure the success of something like that? It's not as straightforward as tracking profits.
It's a mix of quantitative and qualitative metrics. They track things like the number of new customers onboarded through Modi, the volume of loans disbursed, and the overall economic activity within those communities. But they also look at the social impact. How are these initiatives improving lives and contributing to sustainable development?
So it's about balancing the bottom line with a broader sense of purpose. That's a pretty compelling story, but I'm still curious about their financials. We talked about their ambitious profit targets, but what does their balance sheet look like? How healthy are they financially?
That's where the details get interesting. They're actually quite strong financially. They've been proactive in optimizing their balance sheet, particularly as interest rates start to normalize.
So for someone like you who analyzes these things for a living, what are the key takeaways? What should our listener be paying attention to?
Well, their common equity tier 1 ratio, a measure of their financial strength, stands at a solid 12.5%. This means they have a strong capital buffer to absorb potential losses and weather economic storms. They're also focusing on improving profitability by shifting their assets towards higher yielding opportunities, while carefully managing risk.
So they're not just growing for the sake of growth, they're being strategic and ensuring they maintain a solid financial foundation. But what about their debt? Are they taking on too much risk to fuel their expansion?
They're definitely mindful of their debt levels. Their net debt-to-equity ratio is around 0.35, which is relatively low compared to their peers. This suggests they're using a healthy mix of debt and equity to finance their operations.
Okay, so their balance sheet seems to be in good shape. But what about their cash flow? Are they actually generating enough cash to support their ambitious investments and those generous shareholder returns we talked about?
Their cash flow statement reveals some interesting insights. They've been consistently generating strong cash flow from their operations, reaching 7.5 trillion in 2023. This healthy cash flow allows them to fund their investments, pay dividends, and buy back shares without straining their finances.
So they're not just borrowing money to reward their shareholders, they're actually generating enough cash to do it sustainably.
Exactly. And they're also focusing on free cash flow, which is the cash left over after covering essential capital expenditures. This metric is important because it indicates how much cash they have available for things like dividends, acquisitions, and debt reduction.
So a healthy free cash flow is a good sign for investors. It means they have financial flexibility to pursue growth opportunities and reward their shareholders. But how does their free cash flow actually stack up?
Well, their free cash flow has been consistently positive, exceeding 2 trillion in recent years. This indicates a strong ability to generate cash beyond what's needed to maintain and grow their business. It's one of the reasons they've been able to increase their dividend and share buyback programs so significantly.
Okay, so they've got a solid balance sheet,
Yeah.
strong cash flow, and they're generating healthy free cash flow. It sounds like they're firing on all cylinders financially.
Yeah.
What about their earnings? Are they actually translating all this financial strength into bottom line profits?
Their income statement shows consistent profitability, with net income reaching 1.5 trillion in 2023. A key driver of this profitability has been their focus on managing expenses, optimizing their lending practices, and diversifying their revenue streams.
So they're not just relying on traditional banking activities for their profits, they're finding new ways to generate revenue.
Exactly. Their expansion into areas like wealth management, asset management, and their innovative ventures in Asia are contributing significantly to their overall profitability. It's all about diversification and finding new avenues for growth.
It sounds like they've got a pretty impressive financial track record.
Yeah.
But I'm always wary of companies that seem too good to be true. Are there any red flags or potential concerns that our listeners should be aware of?
Well, no investment is without risk. One potential concern is their exposure to the Japanese economy. While they're diversifying geographically, a significant portion of their business still relies on the domestic market, so any economic downturn in Japan could impact their performance.
That's a good point. And we talked earlier about their ambitious expansion into Asia. That's not without its risks either.
Absolutely. Emerging markets can be volatile, and political and economic instability could pose challenges to their growth plans. There's also the competitive landscape to consider. They're not the only ones eyeing Asia's potential, so they'll need to stay agile and innovative to maintain their edge.
It's a high-stakes game. But it seems like they're approaching it strategically. They're not just throwing money at the problem. They're building partnerships, developing innovative technologies, and focusing on sustainability.
Yeah.
But we're getting ahead of ourselves. Let's shift gears and talk about their commitment to sustainability. It's not just a buzzword for them. It's woven into their business strategy.
Mm.
Okay, so we've seen how MUFG is trying to walk that tightrope in between maximizing profits and making a positive impact. It's a tricky balance. But their commitment to sustainability seems genuine. They're not just jumping on the ESG bandwagon. They're actually weaving it into the fabric of their operations.
Yeah, it's not just a PR exercise for them. Their approach to sustainability is quite comprehensive. They've set these ambitious targets for sustainable finance, they've committed to reducing their own carbon footprint, and they're actively engaging with stakeholders on key environmental and social issues.
It's one thing to make promises, but it's another to actually deliver. How are they holding themselves accountable? Are they just relying on good intentions?
They're actually quite transparent about their progress. They publish these detailed sustainability reports, tracking their performance against specific metrics and outlining their future goals. They've even linked executive compensation to their sustainability targets, which shows a real commitment from the top down.
So they're putting their money where their mouth is. That's encouraging to see. But how does their sustainability focus actually translate into business opportunities? Is it just about doing good? Or are they seeing a financial upside as well?
Oh, they're definitely seeing the business case for sustainability. There's a growing demand for sustainable investments, and they're positioning themselves to be leaders in this space. They're developing innovative financial products like green bonds and sustainability-linked loans, which are attracting investors who are looking to align their portfolios with their values.
So it's a win-win. They're doing good for the planet and for their bottom line. That's a pretty compelling story. But I'm curious, what are some of the specific challenges they're facing in implementing their sustainability agenda? It can't all be smooth sailing.
Of course, there are challenges. I think one of the biggest is measuring the true impact of their initiatives. Sustainability is a complex issue, and quantifying the social and environmental benefits can be tricky. They're constantly refining their methodologies and looking for ways to improve their data collection and analysis.
So it's a work in progress.
Mm.
But it sounds like they're committed to the journey, even if it's not always easy. But before we wrap up this deep dive, I want to circle back to their overall strategy. We've talked about their expansion into Asia, their financial performance, their sustainability focus, and their agility transformation. It's a lot to take in. How do you see all these pieces fitting together?
Well, I think they're all interconnected. Their growth in Asia is driven by their focus on digital innovation and financial inclusion, which aligns with their sustainability goals. Their financial strength gives them the resources to invest in these initiatives. And their agility transformation is about creating a culture that can adapt and thrive, in this rapidly changing world.
So it's a holistic approach. They're not just tackling these issues in isolation. They're seeing the bigger picture and how everything is connected.
Exactly. It's about creating this virtuous cycle where their business success fuels their ability to make a positive impact, and their commitment to sustainability enhances their long-term growth potential.
I have to say I'm impressed. They're not just talking the talk. They're actually walking the walk. They're pushing boundaries, taking risks, and setting a new standard for the financial industry.
Yeah, it's refreshing to see a company that's not afraid to be bold and ambitious, both in their business goals and in their commitment to creating a better world.
That's definitely given me a lot to think about. But I think the most important question for our listener is this. If you were considering investing in MUFG, what's the one key takeaway you'd want them to remember?
I'd say it's this. MUFG is a company that's not just focused on short-term profits. They're building a sustainable business for the future. They're embracing innovation, expanding into high-growth markets, and demonstrating a genuine commitment to social and environmental responsibility.
Yeah, it sounds like they're a company worth watching, that's for sure.
Oh?
And as always, we encourage you to do your own research and delve deeper into their story. There's a wealth of information available in their 2024 integrated report and other publicly available resources.
And remember, the best learning happens after the episode ends, so keep those brains buzzing, stay curious, and join us next time on The Deep Dive for another deep dive into the fascinating world of business and finance.